Welcome to Jumping into the Deep End, a how-to guide for new investors, hosted by Women Investing in Security and Education, otherwise known as WISE, and She-Vest with the UCI Paul Mirage School of Business's Center for Investment and Wealth Management. We are so excited to have you join us today because today's session is going to be jam-packed with valuable insights and takeaways from an amazing woman with an incredible background. My name is Elizabeth Lee. I'm a marketing consultant at LPL Financial, and I'm the current chair of the She-Vest Committee. Our mission at She-Vest is to motivate women of every socioeconomic standing to not only develop financial literacy, but to grow comfortable in their command of money management. Over the past few years, we've hosted in-person and virtual programs ranging from topics like redefining your relationship with money to budgeting 101, and even something very specific like investing in real estate and alternatives. And we're very, very excited to be here together and partner with WISE to put on today's event. And it's my absolute pleasure to introduce Angela Dailey, who's the CEO of WISE. She is managing partner at DAI Partners, a national strategic communications firm that works with financial services firms. There, she continues to use her years of Wall Street experience to provide public relations counsel for her financial services clients. Angela has served on numerous corporate and nonprofit boards. And I don't want to steal too much of your thunder, Angela. I think the list of your accolades can go on and on. So I will let you go ahead and take away this virtual spotlight.
Oh, thanks, Elizabeth, for the way too kind introduction and for being such a great partner to WISE. I mean, you're so true that our missions are so similar. It makes so much sense for us to partner. So I'm Angela Dailey, WISE CEO. And welcome all of you tonight to this wonderful presentation. With our virtual format, we welcome participants from all over the country. So no matter what your location, go to our website, wiseinvestors.org, sign up. The price is right. It is free. In 1997, a powerful group of women met in Orange County to put on an investment conference for women. To their amazement, it was a stunning success. Over 500 signed up and they knew they were onto something. Fast forward 25 years later. Yes, it's our 25th anniversary, and WISE stays true to its mission of financial empowerment for females of all ages and all socioeconomic backgrounds. We believe if you manage your money better, you're going to have more options and more opportunities in life. We work through organizations such as Girl Scouts, Girls Inc., and universities such as UCI. And every year we reach thousands with our empowerment message. Tonight's program is part of our groundbreaking Tearing Down the Pink Wall series that gathers the best and the brightest to both educate us and inspire all of us to reach our full potential. And that's exactly what we have tonight. The best and the brightest. Evelyn Zohlen. Evelyn is very close to the WISE family. She's part of our 25-year history and part of our advisory board. Evelyn is the CEO and founder of Inspired Financial, whose mission is to help women through financial transition situations. Evelyn is one of the most admired and respected financial planners, not just in California, but across the nation. She's a sought-after speaker on all topics related to investments, financial planning, philanthropy, and we're just thrilled to have her with us tonight. We have a two-part program. We're going to talk to Evelyn about getting started with investing, and then we're going to talk to her about the career journey that led her into financial planning and entrepreneurship. So just a little bit of housekeeping. Put your questions in the Q&A box, not the chat box, and we'll take them at the end. So evidently, there's a real fear of investing out there getting started. 61% of adults say that they find investing in the stock market intimidating and scary. An even more troubling statistic has 56% of millennial females saying that fear holds them back from getting started with investing. And it's strange because study after study show that women are better investors than men. But I guess they don't believe it. So we have a lot of work to do here, a lot of education, and that's what WISE and She-Vest is all about. So Evelyn, welcome. Thank you so much for joining us.
Thanks, Angela. Glad to be here.
Yes, wonderful. So we're going to start at the very, very beginning. And I want you to tell us, what is the difference between an investment account and a bank account?
That's a great starting point because there is a fundamental difference between a savings account that you would have at a bank and an investment account, because a savings account, by definition, is savings for something that you can't take a lot of risk. This is going to be a safer account because you put $1 in and you fully expect that a month, a year, 5 years from now, you're going to get $1 out. You're willing to sacrifice growth on that for that safety. In comparison, investments, it's almost like you're making an agreement with the markets that I'm willing to take some risk by purchasing shares of a company or a bond, which is a type of loan from a company. But in return for the potential growth that I might get, I understand that I'm going to face some ups and downs with it. Mm-hmm. And there's a time that's right. There's a time to take that kind of risk. For example, if you're looking at a long-term goal, that maybe sending a child to college, maybe you're planning for your own retirement, it might be appropriate to take risk like that. But there are other times that a good old-fashioned savings account is the right answer. For example, an emergency fund, mm-hmm. having that little bit of cash on hand in case your car poops out, or your refrigerator, or here in Southern California right now, your air conditioner. So it's nice to have a stable source of funds, and that's exactly what that savings account can be for. I always tell folks when they ask me, so what should I be doing first? Should I be saving or should I be investing? And the answer is a highly instructive, well, it depends. I think the first priority for me would be if you're working for an employer that has a 401k plan and they're matching your contributions, almost always, if you possibly can, you're going to want to put enough money into your 401k to get that match. That is free money on the table, and never, ever pass up free money on the table coming from somebody else. But after that, take a look at the rest of your situation. And if you don't have an emergency fund, that's probably what you want to do initially, is get started and start saving into that bank account so that you can build up that little bit of an emergency fund.
Well, Ellen, that's all great advice here, and that emergency fund is so important. So, but when we're ready to start taking a little bit of risk, how much money do we need to get started investing? Is it $100? Is it $1,000, $10,000? And if you don't have an advisor to help you, where do you go to set up an investment account?
Right. That is the $100, $1,000, $10,000 question, isn't it? You know, if I don't have much to invest, how do I even get started? And so my suggestion is to at least try to pull together a few $100s, maybe $500. And the reason for that is that just the nature of investing, if you have a very small amount right out of the gate, it can actually be difficult to purchase an investment. Now, let me give you a for example. Let's say that you had $100 to invest, and you wanted to purchase a share of Tesla stock. Well, Tesla stock is currently trading for $283, give or take a little bit, per share. And so with $100, you wouldn't be able to purchase one share even of Tesla stock. Likewise, there are exchange traded funds. This is a pooled investment account that you can purchase, and that you can buy a lot of stocks pooled together. But even those, there's one that I like that is a global exchange traded fund that's managed by a company called the Vanguard Group. And it currently trades at $89 per share. And so again, if you only had $100, you'd be able to squeak out one and a little bit of a share. So I like, if we can, to try to pull together at least a little bit of critical mass, $500 or so, to get started. Now, what do you do about get started? What exactly does that mean? Well, you're going to need to open an account at a financial institution that's a custodian. They're holding your account for you. And what kind of an account? I suggest that you just start with an individual, meaning it's yours, brokerage account. And so the custodian, and I would suggest you check out somebody like Schwab or E-Trade or Fidelity. They will hold that individual account for you. You'll put your $500 into that account, and then you can invest it. And the nice thing is that after you've made that initial investment, all three of those brokers, Schwab, Fidelity, or E-Trade that I mentioned, and there are many others. Those are just ones that you might recognize. The nice thing about those particular brokers is that if you wanted to invest more going forward and you didn't have $500, well, each of those different brokers will actually allow you to buy a little slice of a share of stock or a share of an exchange traded fund. They call those fractional shares. And it's one of the really nice advantages of opening an account at a broker like that is that going forward, after you placed your initial investment, you can actually do little slices. And, little slices over time really can add up to a big investment pie.
Oh, yeah. Absolutely. You start small and it's amazing, especially if you start very young. And I know we must have with us today some millennials to get them started. It doesn't matter. You don't just get started, I think is the point here, right?
Yes.
Just get started. Well, you mentioned ETFs. So let's talk about the investment jargon on Wall Street. Wall Street is filled with investment jargon, which probably was what causes this intimidation and fear. We have mutual funds, stocks, bonds, asset allocation, diversification, ETFs, derivatives. So how important, Evelyn, is it for us to be financially literate and understand what's in our portfolio? Or is it okay just to say, well, I have a financial planner taking care of that, or my brother-in-law is helping me? What is your advice here?
Right. It's essential that we have a foundation anyway in the basics of financial literacy. And, Angela, you commented financial literacy. And in my mind, financial literacy certainly includes investing, but financial literacy actually touches every facet of somebody's financial life. And so that can include things like taxes or creating a will or maybe getting insurance for your car or maybe on your life. And so I'll focus on the investment side of financial literacy, but I think having that foundation is absolutely essential. And you did toss out a lot of impressive financial jargon in your question there. And I want to assure folks that you don't have to know every one of those terms that Angela just tossed out there. But I do think that having that basic foundation gives you a lot of confidence and is empowering to feel like I know enough to make good decisions, and also know when I've reached my boundary and I'd like to get some help. And so the good news is that there are a plethora of resources to improve your financial literacy, your financial education. And so certainly webinars like this, WISE and SheVest and many, many other nonprofit organizations put on just tremendous courses and webinars on how to improve your financial education and learn more and take ownership of your financial future. So lots of opportunities like this, but let's be real, you're going to spend an hour with us tonight. And I'm hoping that you take away some great tidbits, but there's obviously so much more than what we're going to be able to share with you in an hour. And so take some time and invest in yourself. You're so worth it. And so there are lots of great courses, even online, and these are free. It's not that you have to run off to Harvard and get your MBA in finance and portfolio management. These are free courses that are available through nonprofits or education institutions on the basics of investing or the basics of personal finance. And so I'll toss out a couple. I've got no relationship with any of these entities, but I've referred folks to them because I think they have some great material. One is Morningstar. And so if you just go to Morningstar.com, Morningstar has a great series on starting investing that I think lays good foundation if you want to learn more about investing. And then there's another website called Investopedia, Investopedia.com. They too have just some terrific basic courses and basic information on how do I start investing and just learning some of that initial jargon that Angela kind of tossed up in the air. It's like a financial services tossed salad you had going there for a moment. But beyond, I would encourage you that if after you've kind of dipped your toe into the basics and foundation of investing, go ahead and wade in up to your knees and learn more about personal finance in general. I'll often tell our clients that I could be the best investment professional in the world. But if we're losing 50% of your gains every year due to poor tax planning, or if we don't do a good job preparing your estate documents and you have a child who's not prepared to inherit money, receive money, then we haven't done a good job. We've sort of failed in preparing for your full financial picture. So part of financial literacy isn't just the foundations of investing. And I know that's why you're here today, but I'm going to encourage you to go beyond that and dive in and learn a little more about your broader personal financial situation as well.
And that's so critical. I mean, we've had webinars on estates and planning, and young people think, well, they don't need a will. Well, yes, they do. So Evelyn is totally right. This is a big picture. Is really what you have to face, but one step at a time, right?
Right.
One step at a time.
Just a little bite.
A little bite here, and by the way, it's a lifetime of learning. It's not, as Evelyn said, it's you don't expect to come away from this after an hour and you know it all. No, it's just to get you started on a lifetime of learning, of knowing how to manage your finances and knowing how to manage your portfolio together with advisors, et cetera, but to know a lot. Well, okay, I've had many mentors on Wall Street in my career. One of my favorites is a man who was a legend on Wall Street, I.W. Burnham, who's founded one of the most important and more powerful investment banks. And Mr. Burnham loved to say, I know two things about the stock market. It goes up and it goes down. So prior to 2022, you had a number of years of great performance, outsized performance. And 2022 has not been so kind to investors. It's like kind of a wake-up call that the market does go up and it goes down. So how do you talk to your clients about risk? You mentioned it at the beginning, but how do you have these discussions about risks in the market? And another subject that I think really important is our own personal risk tolerance, because it's all different. Some people are big risk takers, others want to be very conservative. So how do you manage through this risk discussion?
Yeah, I had to smile when I heard you quote Burnham. And another related quote to another investing great is from the Oracle of Omaha, Warren Buffett, and he once said, "When the tide goes out, you see who's swimming naked." And he was referring to what happens when the markets drop and what happens to investors. Who had a plan and a strategy, who was really clear on their ability and willingness to take on risk, and who wasn't, and goes sprinting for the beach because they had no pants on. If I'm going to really work that analogy a little bit. So,
add a little bit to it. Yes.
Yeah, my own embellishment, why not? I'm sure Mr. Buffett would not mind me taking a few liberties with that.
I think that's exactly what he had in mind, Evelyn, for you to take it a little further. Okay.
Right. It's the past 9 months, no doubt about it, really painful, really, really painful. And in some cases more than painful, sometimes in some cases really frightening for somebody who thought that they were going to retire in October this year and maybe still plan to retire in October. It's a really scary moment. And I can only imagine how many versions of should I still do it and what do I do now would play through that person's head. However, as bad as this is not the worst we've seen in the last 2.5 years. I just want to dial the clock back just a little bit to February and March of 2020. Okay, so for some perspective, from January 1st of this year through market closed yesterday, the U.S. stock market, and I'm using the Russell 3000, which is just an index that measures the performance of the biggest 3,000 companies traded in the United States publicly. That Russell 3000, as of close of market yesterday, is down about 16.5%. It's down 16.5% over the past 9 months. Not fun. Because these are stocks that pretty much any diversified portfolio, and most investors are going to own these. And so that really hurts. But I'll tell you what hurts more is between February 19th of 2020 and March 23rd of 2020, so a little over a 1 month period, the S&P 500, which is those 500 largest, I was talking about the 3,000, the 500 largest dropped 34%. 34% in a little over 5 weeks. We're talking 5 months or 9 months that we've just experienced, but in a little over 5 weeks, the US stock market dropped 34%. And, on March 24th of 2020, who knew? Nobody knew what was going to happen next. I'm sure we all remember that. And just to really, pound this one home, on a single day on March 16th that year, all the major US stock markets in one day dropped 12 to 13% in just one day. And so I mentioned that because, it's been really painful the past 9 months, but we actually experienced something much dramatic, much more, much worse than what we've had in the past 9 months back in early 2020. And I think the reason I'm really pointing that out is because we have a little bit of a short-term memory when it comes to our experiences in the market. Mm-hmm. You're right that what everybody remembers is how 2020 ended and how 2021 ended. And both of those were astonishingly good years in the markets. And now we're looking at 2022 feeling like, oh my gosh, this is horrible. And yes, it is. And yes, we're experiencing things that it's been a long time. I mean, anybody who's looking at the bond market right now is got their eyes popped out thinking, what's going on? Bonds are not supposed to be down as much as this. And you'd be right. This is a once or twice in a century kind of moment that we're having in the bond market, but it does happen. And so, Angela, to your question about, well, what do you do about market risk? How do you possibly plan for this, handle this? Who could have known back in January that we'd be down 16.5%? And you can't. You can't know. And this is what is key about making the decision to wade into the waters, to go ahead and make the decision to invest. And that is to understand that there is a cost to the returns that we got in 2020 and 2021 is that their markets move up and down, and there will be a down. Over the long haul, it's normally up, but there will be a down. And the key to being able to navigate and hang in there on those down moments is to be really clear about what kind of risk do you need to take? There's this balance between the being able to sleep at night and staying in your seats when the seas get rough. There's this real balance. And so you always start with your goals. I mean, what's this all about? Because if the money in your pocket right now that you're thinking about investing is money that you plan to use to buy a car next March, because you placed the order last week and they're telling you it's going to take 6 months to show up. But if you need to use that money to buy a car sometime next spring, you're not going to invest that. You are not going to take any risk. That's a perfect place or perfect description of what you should use your savings account for. That money should go into a savings account. But what if that money is for a down payment on a house that you hope to buy in 5 years? Okay, well, that's a very different goal. And I don't know that I would recommend that you put all of that in the stock market, because we've seen that you can definitely have some down moments that in a 5-year period, you really can't be assured that you're going to be up as much as you'd like, but maybe some of that 5-year goal that you put a little bit into stocks and most of it in bonds. But what if this is for your retirement? You're 32 years old and the good Lord willing, you got 40 years ahead of you before you retire, and then maybe another 25 years in retirement after that. Well, I mean, if you've got a 65-year investment horizon, go for it. You can ride out pretty much anything with that kind of an investment horizon. So start with goals. That should always be your starting point when you're trying to make a decision about how much risk should I be willing to take with my investment. But then the second is your tolerance. How much your goal will sometimes indicate how much risk you need to take, but how much how much can you tolerate? How much can you stand to take? And your ability to take risk is as important as your need to take risk to reach a particular goal. Because if you are stressed and anxious and fearful all the time because of the risk that you've decided to take with an investment, then I'm going to tell you, life's too short for that. Life is too short for that. You need to dial back the risk that you're taking and develop a plan for how do you achieve your goal without taking on that much risk. And you might be saying, okay, Evelyn, that sounds great. I got the concept, but really, how do I know how much risk I can take? Because back to my my liberties with that Warren Buffett quote, everybody has super risk tolerance there. Everybody's very risk tolerant when the markets are going up, up, and up. Not quite so much when markets are coming down. And the trick is to take on that level of risk that you can tolerate all the time when markets are up or are down. And so there are some tools I would recommend that you consider when you're trying to evaluate with a little bit of objectivity how much risk that you're comfortable taking. And so you can, those brokers that I mentioned to you, the Schwab has a risk tolerance questionnaire. Vanguard has a risk tolerance questionnaire. If you're working with an advisor, your advisor should be able to, if they have not already, should be able to help you with a risk tolerance assessment, because it doesn't have to rule your investment life, so to speak. But I think it's an important data point to have as you're considering the universe of information available to you to make decisions about your investments. And one final comment I would make is on the ability or interest in taking risk. What is your personal risk tolerance is. Don't be fooled that if I just leave it in cash, I'll be safe, because there is no such thing as no risk. Anybody who has had to buy a gallon of gas or a loaf of bread in the last 9 months knows what happens when there's inflation. And if you leave all of your money in cash, thinking it'll be safe there, well, $1 might still be $1 when $1 into the savings account might be $1 coming out of the savings account, but that $1 is not going to buy you nearly as much. And I think it's a much more insidious sort of risk, because it's naked. You can't see it. It's completely transparent to you until you take out that $1 or $10 or $100 and discover that what you'd hoped to buy, you got to go get another $25 to do it. And that can be really frightening. And so there is no such thing as no risk. You must take a form of risk. And the trick is to understand how much risk do you need to take to accomplish your goals while still being able to sleep at night and make sure that that's within your own personal risk tolerance.
Evelyn, that's all such great advice, because we want to sleep at night. And if you're not sleeping at night, life is too short. You have to realize that you can't stand that up and down and severe volatility. And have to, what that means is, right, that you structure for this client a more conservative portfolio.
Right, exactly.
Because they're different categories: aggressive, moderate, conservative.
Absolutely.
So you have to figure out where do you fit in there.
Yeah, and I want to comment really quick, because sometimes we toss around descriptors like the ones that Angela just used. Oh, it's an aggressive portfolio, it's a conservative or a moderate portfolio, and you might be scratching your head right now thinking, okay, I kind of get conceptually what aggressive might be or conservative might be, but really at the end of the day, what Angela and I are talking about when we say an aggressive portfolio or a conservative portfolio is just how much exposure, how much risk are you taking in buying stocks versus maybe buying bonds, or maybe leaving a little bit in cash. And so an aggressive portfolio is taking on a lot more risk. And the way that it's doing that is it's buying more in stocks or other risky types of investments. Whereas a conservative portfolio, it might still have some stocks, but maybe it's only got a 10% allocation to stocks. And maybe it's got a 90% allocation to bonds that are going to be a lot more stable, and maybe even a little slice of cash. I don't want to imply that cash is bad. Cash is your friend if you need to buy something in the next 6 months. Cash is definitely not your friend if you're thinking about retiring in 65 years.
Yeah.
So I
Well,
kind
you
of
know,
cut you off there, Angela. But
no. I think that was very important. I mean, what does it mean? And I think what we're saying here is that portfolios are customized for the
exactly
person.
right.
Not everybody's not going to have the same or should have the same portfolio.
No.
You know, some are going to have Tesla stock and other are going to have ExxonMobil. And it's all a matter of how you're going to view yourself and long-term investing. Well, but let's expand on that a little bit here. Okay, so the markets have been doing really well prior to 2022.
Right.
And they kept going up, up, up. And how did you deal with clients and also with newbie investors that when they see the market going up so quick, this FOMO or fear of missing out?
Right.
How do you deal with this relationship to money, behavioral finance, and the emotions that are tied to it? And then conversely, when the market is plunging and down, as you said this year, you know, what was down 20%, now it's down 16, and who knows what happens next.
Right.
How do you stop people from that wanting to protect themselves and sell? What advice do you give this to?
You know, it's interesting because there is an expected rate of return over the long term for different types of investments. You know, the US stock market, broadly speaking, there's a decades-long expected rate of return based on the performance of the US stock market. What's interesting is that when the actual return is much higher than that, let's say that expected rate of return was 10%. Well, if the actual return that somebody gets in their US stocks is 14% in 1 year, nobody calls me about that saying, hey, this is not the expected rate of return. What's going on here? Yeah. However, if that same year, the actual return of the US stock market was 2%, I get a few of those phone calls. Hey, the expected rate of return was 10%. I'm only getting 2%. What's going on here? Well, what's going on in both cases is there's variability. There's plus and minus on both sides. That's how we end up with averages, right? Is that you've got some that are above and some that are below, and we end up on the average. And so you commented about behavioral finance, and that's very much a jargon term, but what it's talking about is how our experiences with money growing up and our family story when it came to investing or budgeting, and maybe our own experiences as young adults or in a partnership with a spouse or in a business, all of that comes together to shape our attitudes and beliefs and how we act when it comes to finance and comes to investing. And so the emotion and that all that history and perspective that we bring absolutely has tremendous bearing on how we respond, how we act when markets are going great and when markets are falling apart. And I will often joke with our clients that one of my most important roles as their advisor, their financial planner, is to throw myself between them and an emotionally charged decision, whether that's either direction. That in March of 2020, I had a client who really worked me over about wanting to pull a lot of money out of their well-diversified, well-built portfolio, pull a lot of money out of it and drop it into cryptocurrency.
What?
Cryptocurrency.
Oh, cryptocurrency.
Yes, cryptocurrency. And because he was absolutely convinced that he had already missed the boat, that it was gone, and he was never going to be able to recover from the loss of us not getting in. And he was absolutely convinced. And I kind of got between him and what I thought was not a good decision, because they had a good portfolio. They did not have a lot of extra room to take on a speculative investment. In my opinion, cryptocurrency still, it was and is a very speculative investment. And so I helped shield him. And of course, he hasn't called me yet to thank me for that, but I can imagine that that was a miss, or some painful loss that he did not miss. And then on the flip side of that, I will also try to, and I'm being a little tongue-in-cheek about getting in between folks in a bad decision, but I'll also make sure that we're spending some time talking with folks when they're anxious about a market decline like what we've experienced. The fact is that there's a lot of anxiety that can come in moments like these. And I think truly our first line of defense when we're in a moment like this, I'm going to go back to goals. Our first line of defense is to really be clear on, okay, what are these investments for? What are these for? Because back to my three examples, the car, the house, the retirement. Well, if the investments or if the cash is for a car, we're not in the market anyway. We are not going to be investing if we are buying a car and we need the $25,000 6 months from now. If it's something that we need for a down payment on a house in 5 years, well, yes, we are down some, but a lot of this is in bonds. And so there's not as much volatility there. And if I'm looking at that retirement 40, 60 years from now, I know 9 months is painful, but 60 years from now, you will hardly remember it. And so what can we control right now without jeopardizing future you? And I will talk a lot about the future Angela. The future Angela will say to you to not be frightened right now, to stay steady. You have a good plan. And if you stay steady in this moment, that it will pay dividends literally and figuratively down the road. So first line of defense is to just really be clear on the goals and make sure that your investment strategy is aligned with those goals. And then the second is, we know it's going to come. We know absolutely that it's going to come. I'll tell you candidly, I'm in the financial services industry for knocking on 25 years. I started when I was 3. Okay, not really. I didn't, but I'll
10, maybe, Evelyn, 10.
Got it. Yeah, I don't want to stretch the truth. Yeah. But I've been in the business for about 25 years. I've had my own practice for about 20 years. And in those 20 years that I've been doing this, 25 years, I saw the tech bubble in 2000, year 2000, obviously 9/11 and all that came from that in 2001. Obviously, the Great Recession in 2007, 8, and 9. We had some pretty big bumps in 2018, and then of course most recently. And so nobody should be surprised. No, none of us should be surprised about this. It's so first line of defense is, what are the goals? Be really clear and like, I got my goals and I'm keeping my eye on the prize. But your second line of defense is, I know it's going to come, and so what is going to be my plan when it does? Have a strategy. What would I do if the market dropped 10%? What am I going to do if the market's going to drop 20%? And this is a conversation to have. Obviously, it'd be nice if you had it before that moment actually occurred. So you can talk about it from a little bit of a disinterested distance, almost as like a disinterested observer. So what would I do if? Talk it out. And also if you're in the moment and you haven't had a chance to talk it out, but have your goals changed? Because if your goals haven't changed, that should definitely give you pause about making any big changes right in the moment. And then thirdly is, to think about, so let's say I do decide to make a big change. I do decide to get out. Okay. All right. And I'll say this to my clients. Okay. But I need you to tell me, when do you get back in? When are we getting back in? Because you got to be right twice, right? If you think the market is going to continue to drop like a rock and I'm getting out, okay, that's fine. Okay, but when do we get back in? And, it's interesting because the answer sometimes I'll get is, well, when it comes back up. And so I'll say gently, okay, so I want to be really clear on this, that you want me to sell when it's down 16%, and you want me to buy back in when it's come up another 10%, and then buy back in when it's only down 6%. So you want me to sell it down 16 and buy it. And of course they understand it. And I need to be very gentle with that, because I don't want it to be a poke in the eye, but rather you've taken it down. You're here right now. And so unless the goals have changed, then let's ride this out and wait for it to come back. But let's not be that person that sells low and buys high, because that's what the alternative is. So I think that's one way that I help folks with some of the emotion and the behavior. And Angela, a question that I'm getting right now from folks that are new clients that are coming on board with us is, well, when should I invest? I mean, this seems like a terrible time to invest. The market is awful. It's up, it's down, but it seems down twice as much as it is up. So this looks like a terrible time to invest. So when should I invest? And the answer is, unless your crystal ball works better than my crystal ball, the answer is now. And I'd be very gentle about that, but it's true. We can't predict the future. I have no idea if today at market close, we bottomed out, and over the next 6 months, we are going to skyrocket. I don't know that. But I do know that we've had 9 months of pretty rough markets. And I just start to look at research, and I start to look at the evidence to get some indication of what has been the experience. And I'm a huge advocate of research. You commented earlier, Angela, that this is like a lifelong thing, and it is. 25 years I've been in this business, and I spend hours and hours, dozens of hours, more than that, every year in continuing education. And because this is a constantly moving environment, and there's a ton of new research that comes out every year. And one that I think is especially pertinent to the question of, is it a good time to invest, or when is a good time to invest, is the research that's been done on just that. If you invest in a down market versus invest in an up market, what are your probabilities of success in achieving a particular goal or a certain rate of return? And it's interesting because the research shows you're actually better off buying in a down market than you are in an up market, because you're getting more shares at that lower price. And the key, though, is the goal. If this is a near-term goal, okay, maybe not. But then that goes back to savings versus investing. But if it's a longer-term goal, the answer is now, because it's a great time to buy if you've got a long-term goal.
Yeah, there's never a perfect time, Evelyn. I think that's where you're going with this. And I have heard that too from many very savvy investors, that more money is made in bear markets than bull markets. So
exactly,
there you go. So you've talked a lot now about the role of an advisor, and the role of advisors to manage expectations, to manage emotions, to assess the risk tolerance, and all of these things. So if a person wanted to hire an investment advisor, how do they go about finding one? And let's talk also, I think that as part of this education, we should touch on fees. And, how do, when you buy an index fund, when you buy a mutual fund, when you buy stocks, if you buy an individual stock, you don't have a fee involved, but everything else you pay for this. People are not in the business to be altruistic. Right. So talk to us a little bit. How do you find an advisor? How should you be looking at fees, or questions you should be asking about fees? Help us out here on getting an advisor involved if they're ready to do that.
Right. And to your point about if they're ready to do that. So I'm going to back up for 2 seconds and say, first of all, you don't need to get an advisor. You don't need to have an advisor to get started. I think that with a very modest little nest egg, and contacting one of these established brokers, like I said, a Schwab or Fidelity, you can get started on your own. It just takes time and attention, and you can't ignore it. You can't ignore it. This can't be like a Rip Van Winkle moment. And if you're really young and you don't know who Rip Van Winkle is, Google it. There's a story there. But you can't just set it and forget it and then come away in 20 years and see, I wonder how that worked out. It takes some attention. And so there's a couple of various levels of help you can get. You can go online, and there are digital advisors. You could go to a Schwab or a Vanguard or a Betterment, or you can Google robo advisor, and there are whole lists of these entities. And these are digital solutions for managing investments. Now, what's important to know is it is just investments. That's all they're doing, is managing investments for you. But many of these robo advisors, they don't have account minimums. So if you only had $100 or $200, that many of them would say, sure, we'll work with that. And it's relatively low cost. Angela, you're right that these aren't nonprofits. They're hoping to make a little bit of money to keep the lights on and make the mortgage and send the kids to college. And so these robo advisors will charge, maybe between 0.15% up to 0.4% of what they're managing for you as the fee to manage those investments. But the thing to keep in mind is it is just investment management. So there probably won't be anything as far as helping with tax planning or, should I be saving to my retirement account or not? There's not, and very, very little human interaction with these. However, if somebody's looking for strictly investments and they feel like they have everything else sort of dialed in and they're watching it, okay, that's a great solution. If, however, you really would like to work with a person, you would like an advisor who's creating a custom solution for your situation, I do have a couple of recommendations for you to be thinking about. The first is that I would recommend that you work with an advisor who is a fiduciary. And that's a legal term. I know I'm tossing jargon, but this is an important one for you to tuck into your toolkit, because a fiduciary means that advisor is always required to put your best interests before their own. Now, that may sound like a blinding flash of the obvious to you that your advisor would, but that's not always the case. And so just a good question to always ask right from the outset is, are you a fiduciary? Will you be acting in my best interests? Full disclosure about my bias. I'm a certified financial planner professional, CFP professional for short. And I would also recommend that you consider working with a certified financial planner professional, because this credential is truly the gold standard for financial planners. And this is somebody that you can count on having gone through a pretty rigorous academic course. I sat for an exam that I swear it felt like the bar. I thought my head was going to explode before I got through the darn thing. And they have to have a minimum amount of experience and commit to an ethics standard before they can use the CFP designation. And so you can search for a financial advisor online. There's a couple of sites. Let'smakeaplan.org is one. There's another one called plannersearch.org, either of those. And you can search off of geography. You can search off of the kinds of services that they provide. Do they have a particular niche? Do they focus on executives? Do they focus on young families? You can search and parse out. Do they?
That's right. They have specializations. Absolutely.
Exactly right. And then the kind of the last question I think is really important to answer that you asked, Angela, is around compensation. How financial advisors are compensated. There's a handful of methods that they can be compensated. The first way that a type of financial services professional could be compensated is off of a commission of a product that they sell to you. That might be selling a mutual fund or an insurance policy or an annuity, and they would have to disclose to you that they are going to be receiving a commission. But that would be one way that a financial services professional could be compensated. The other ways, and this would be for financial advisors who serve as fiduciaries, is you could pay them by the hour. You could just contact them and say, hey, I'd like to
get some advice on an hourly basis.
Exactly, right. You could have a flat project fee. It'll be $3,000 to do this project for you. Or for somebody that maybe has more complexity and needs ongoing management, customization with a lot of moving parts and pieces in their life, then having a planner who is providing that full service, they might charge a percentage of assets that they're managing on your behalf. So, for example, I commented that the robo-advisors for just investment with the digital solution might be between 0.15 and 0.4%. for an advisor that's providing that full service, you could probably expect to pay closer to 1% for the additional services that they may provide. So there's a variety of different ways that you can work with an advisor. And the good ones, if you ask them, what's the best way for us to work together? They'll tell you. They should be open and transparent about it and feel comfortable with that.
Well, that's it's so true. I mean, I think the important thing is to understand what you're paying, and also to understand what is a fair fee, right? Because if a fee is a standard, there's no such thing as quite standard, but there is a range, and just make sure you're not, overpaying. So yeah, and I think all of that is great advice, Evelyn. We're running a little short of time here. Because we wanted to take the questions, of course. So give us 3 takeaways from this presentation that you think we should all keep in mind. And I'm going to add my own, and right now, and just say that this is a lifetime that you need to focus on to a greater or lesser extent, depending on your interest, but we all need to pay attention.
Absolutely. So I will piggyback on Angela's observation to own your success, own your future, and really embrace it, because you deserve it. You are worth the time now for the future you. And speaking of time, so my first important takeaway is that time is really your friend. Back to when is the right time to invest? Well, if your time horizon is long, now, because the power of compounding interest and investments growing on their growth in the future is like the 8th wonder of the world. Compounding can move mountains. So start now is the first one. The second important takeaway would be to know thyself. Back to goals. Your goals should really rule your investment decisions, and right behind that would be your comfort taking risk, but the goals really should drive the bus. Or if I go back to diving in the deep end, they should drive the ship when it comes to making your investment decisions. And then the third one is we talked a little bit about, well, what's an aggressive portfolio and what's a conservative portfolio? And in all of those instances, wherever you might land on the spectrum, the key is to not bet the farm on any one thing. If you had $500 to invest and that's all you had, you might want to think twice about putting all of that on one stock. And so go ahead and diversify and make a decision in between different types of asset classes, stocks, bonds, cash. And then, because that is going to have so much more impact on your long-term success than picking the right one stock today. And so go ahead and diversify. And if you're unsure about how to diversify, that might be a good use of time for that 1 hour if you want to hire a financial advisor.
And I urge everyone to take a look at the WISE website. We have 25 tips on how to build wealth from all of our board members. And I think, Evelyn, you participated in that as well. Yeah. A lot of common sense advice to do that I think is very, very instructive. They're very short, maybe, 100 words. So please go check that out. So Evelyn, now we're going to pivot into your career before we take the questions. So I want to urge everybody. I see we only have 5 questions in the Q&A box. So put your questions in there. And after a short discussion with Evelyn about her career path, we're going to transition to Elizabeth, who's going to field those questions. So Evelyn, you've had a really interesting career. And when you read Evelyn's bio, you're going to see that she was, she went to college, she went into the Air Force, she was an intelligence officer in the Air Force. Then somehow she pivoted into financial planning, and we're going to ask her how that all happened. And then she decided to become an entrepreneur. So Evelyn, talk to us about this career path. It's really, really interesting because you went from one thing that doesn't seem related into another.
All right. Thank you for that. So as Angela mentioned, I actually went to college on an ROTC scholarship. And after I graduated from college, I received a commission as an officer in the United States Air Force. And I had actually thought that I would stay in the Air Force for a full career, but life and relationships moved me in a different direction. And after I got out of the Air Force, I actually was recruited, I was headhunted by, I jokingly call it a little mutual fund company just outside Philadelphia, because I was recruited by the Vanguard Group. And I imagine many of you are familiar with the Vanguard Group, and actually they're a very large mutual fund company outside Philadelphia. But at the time, obviously, I didn't have a whole lot of financial services experience coming out of the Air Force. I was an intelligence officer, and so I have good interpersonal skills. I like talking to people, shockingly, and I'm pretty organized. I'm really good at research. And at the time, Vanguard thought that they would take individuals who had foundational skill sets like that and then teach them the details of the financial services industry. And so they hired me to be a relationship manager in their institutional client services. So I'm taking care of big companies that have their 401k plans and profit sharing plans and such at Vanguard. And hat tip to Vanguard. They're a terrific company, and they had great internal training. I learned more than I ever wanted to know about employer-sponsored plans. But they also supported me when I got my MBA in finance and portfolio management from Villanova. And then when I decided that I was really interested in personal finance, because as a relationship manager for these 401k plans, I interacted predominantly with all the mucky mucks, the senior leaders in these companies. Talking about plan design and investments and such, but we would encounter, if there was an individual participant situation that was hard, it would bubble up and land on my desk. And I just over the years saw over and over some really heartbreaking individual participant situations that I would look at these and think, if somebody had just gotten to this family a year ago, or even better yet, maybe 10 years ago, instead of facing the financial crisis that I'm trying to help them resolve right now, they'd be in a much better situation. And that was what really inspired me, no pun intended, to start working on my certified financial planner designation, because I thought I want to help them. I want to help those individuals, because the big corporations can figure it out just fine without me. And so I ended up leaving Vanguard and starting my own financial planning practice in 2003, and just outside Philadelphia. And in 2005, I actually bought another financial planning practice and merged it into mine. And that's how I ended up in Southern California. I've been here since 2005. And I love the work that I do, because I think that financial planning can change lives, that it can really help clarify goals and create a plan or strategy to achieve them. And some of my proudest moments is attending a retirement party, or watching a kid walk across the stage at graduation. I bawl my eyes out every single time. So it's been an excellent journey, and I've got more ahead of me. I've got a ways to go still.
Well, I think we can all see, Evelyn, from this whole discussion tonight, why you are one of the most respected financial planners on the planet. So thank you for all of that. So now what we're going to do is we're going to have Elizabeth come back on and field these questions. And then we have a survey at the end. Please stay and fill it out, because it's a big help to us in terms of guiding us for the future.
Absolutely. And that was such an incredible talk. Thank you so much, Evelyn, for all those insights you shared. Angela, such strategic questions. And I love how we got a little bit of your own story as you moderated today's session. And I see about 7 questions here in this Q&A box. But to get us started, you talked a little bit about your CFP and how it's a designation that you're proud to have. I got an audience question about quotas. Do you have quotas to meet in terms of education credits?
Oh, yeah.
Things like that. Could you speak to that a little bit more?
Absolutely. So you like to think that after you've done all the education, you sat for the exam, and you worked for 2 or 3 years to get the experience, and you signed off on the ethics, that you could say, hallelujah, I'm done. But no, and it goes back to my comment earlier about it sort of being a lifelong learning opportunity, because the world around us is changing constantly. Tax laws, estate laws, investment research, constantly changing. So as a certified financial planner professional, I have a continuing education requirement of 30 hours every 2 years, including an ethics requirement. They want to make sure we stay squeaky clean on ethics as well. And so it's what's interesting is that when I get my renewal notice, I start dusting off all of my continuing education that I've done over the last 2 years. And it's not uncommon to end up with, 60, 70 hours of continuing education, because what we do is very interesting and it's ever changing. So it is really important for us to stay current, and the CFP designation helps us stay on track there.
Absolutely. You also talked a little bit about diversification as one of your top 3 takeaways.
Yes.
And you mentioned kind of at the top level to stay diversified against different asset classes or across different asset classes. Could you talk a little bit about why or how that helps mitigate risk?
You bet, because different types of assets, and when I say assets, what I'm talking about is, stocks. And a stock is just a share of ownership in a company. One share of Apple stock is a tiny little sliver of ownership in Apple, the company. And so stocks move on particular market cycles that are very different than maybe a bond. And a bond is just a loan that you're making. If you buy a Disney bond, you're basically loaning money to Disney, and they are making a commitment that at the end of 5 years or whatever the maturity of your bond is, they're going to give you your money back. And in the meantime, they're going to pay you some interest. Well, a stock as an asset and a bond as an asset, they fluctuate and move in value on very different cycles, and different things impact how those move. And so what we want when we diversify, when we own a little of this and we own a little of that, is I want to create something that instead of doing this, having huge swings in value, it softens it. It's not going to go up as much, but it's not going to go down as much. They kind of counterbalance each other. And I'm talking about just 2 different types of assets, stocks and bonds. But what if you throw real estate into the mix? Real estate, that has its own cycle as well. And what if we're talking about US companies versus non-US companies? They have different cycles. And so a little of this, a little of that, it really softens volatility while not sacrificing growth potential.
Got it. Thank you for explaining that a little bit more. That was a very good high-level address for answering and addressing like what diversification means, because we hear it a lot. It's hard to avoid it.
Right.
But it's basically don't keep your eggs in one basket, and just making sure you're aware of the different kinds of cycles that we would see.
Right. Exactly.
And I actually had a quick clarification about the quotas question. It was about production, not education quota. So I haven't heard that before, actually.
Oh, no. Certified financial planners don't have any sort of production quotas. I mean, as a matter of fact, certified financial, most certified financial planners aren't selling any products. I don't sell any products. And so but it's a good question to ask your advisor is, do you sell products or do you have quotas that you must satisfy? But there's absolutely no sales component or quotas component associated with a certified financial planner designation.
Gotcha. And thank you for clearing that. That certainly helps clear the air for the person who asked the
question. Sure.
I have 2 questions specifically about just getting started. So people seem ready. They want to start picking out their investments. So one of our attendees asked, where do I even start with a list of stocks and bonds? Like, how do I even start dipping my toes in?
Yeah. So this, and so if you had 3 advisors having a panel right now, all 3 of us would probably have a very different perspective on this. Because if you are truly just getting started, literally, I've got nothing invested. I got a little bit in a savings account, and I'm going to grab $1,000 or $500 out of my savings account. Okay, Evelyn, here it is. What do I do with this thing now? I would not recommend you go out and buy an individual stock. I would recommend that you go buy a mutual fund, or even better, an exchange traded fund. And I know, I'm sorry, I'm throwing out jargon. I would definitely suggest you Google that, because it's basically a pooled investment. You and I and 100,000 of our closest friends all chip in money together, and we pay Elizabeth to manage it for us, and then we can buy little slices of it. So the reason I would recommend you take your $500 and start with an exchange traded fund is because that exchange traded fund can then, on your behalf, will go out and buy thousands of companies, and you'll own skinny little slices of thousands of companies. And so if one of those companies or 10 of those companies has a bad quarter, it doesn't turn your $500 into $386. That it back to diversification. And so for our clients, I use exchange traded funds for all of them. All of them. We don't do any individual stock picking. And every now and then one of our clients will say, yeah, but I want to. And I say, absolutely. We have built a portfolio that's designed to achieve your goals. How about if we carve out a little bit, and then you can invest and do what you would like with this, but it's not going to threaten the rest of your goals. We're going to stay on track with that. And so if you would like to research individual stocks, there's a lot of great online resources. I like Morningstar. I think that they tend to be pretty objective, and their tools, they're free and their tools are pretty good. And so if you're really wanting to dive in on individual stocks or bonds, that's a good place to go. Morningstar, so if I'm convincing you that maybe you do want to invest in a diversified fund of some sort, Morningstar also has some really great tools to research exchange traded funds first. And if you really are thinking, oh my gosh, for Evelyn, for heaven's sakes, just tell me what it is, I would buy a global. If you're looking for investments, I'm like, okay, I'm 28 years old. I got years ahead of me. I want to get in the market. Put me in, coach. Take your $500 and buy a global stock ETF. There you go.
It sounds very diversified. You're
it would be
diversified across regions, non-emerging, emerging markets. You got all of that in the mix.
Yeah, it would have a little of everything.
Mm-hmm. And I love that you talked both to stocks and bonds, because the other follow-up question was, someone was wondering, do you buy stocks the same place you buy bonds? Do you buy?
Oh no, that's a great question. And actually, they are slightly different markets. Now, I'll tell you with bond trading, unless you're buying U.S. Treasury bonds, which are exactly what they sound like. These are bonds that are issued by the United States government, the United States Treasury. You can actually buy United States Treasury bonds directly from the United States government. You just go to Treasury Direct as the website, Treasury Direct, I think it's .gov. And you can buy directly from the United States government. But other than that, you're having to go to a trade, you would be interacting with a bond trading desk. Now, there's a big difference when you're buying and selling stocks versus bonds, because I mentioned earlier, you can do, some of these brokers will allow you to do fractional trades on stocks, little tiny slices of stocks. And it won't move. You're not going to end up paying a lot more for that stock just because you're doing a little fractional trade. Not so with bonds. I'll tell you really candidly that unless I have literally like $100,000, I'm not going to go out and buy an individual bond, a Disney bond. I'm not going to go out and buy it unless I got at least $100,000, because you end up getting gouged on the price of the bond. If you have, only $1,000 or even 10 or 20,000, you really get gouged on the prices. Their bond traders are looking for big blocks of trades. And so if you're buying bonds, I highly recommend that you consider using an exchange traded fund or a mutual fund.
Thank you for that, Evelyn. And I'm really excited about this question because it is, first of all, it starts with thank you. So thank you so
thanks,
much,
Mom. I appreciate that.
It could be. The question is about specifically about women who are learning about investing and financial planning later in life.
Right.
Say they're 10, 15, maybe less years from retirement or hopeful retirement.
Right.
What kind of advice would you give to them in very high level?
All right. That's that can feel really scary, right? Because my firm, we focus on taking care of women in transition. We work with a lot of ladies who are coming into their financial own, maybe a little bit later in life. But even if they aren't facing, the death of their spouse or divorce, we as women, we often will sacrifice our own goals and dreams to support those of the people that we love, whether that's siblings, whether that's spouses, whether that's our children. We end up putting our own on the back burner and to our own detriment sometimes. And so I understand that anxiety and that slightly panic. I feel like I'm so late to the game. What do I do? And so the answer is, first of all, it's okay. Let's put together a plan. I would literally start if you are truly just, wow, I'm in my early 50s and this is my first rodeo when it comes to investments or thinking about my personal finances. The resources that I mentioned, as far as getting that foundation and investments information or on personal finance, those resources are great if you're 28 or if you're 58 years old. And so just building that foundation. And you too, you might be a good candidate to sit down and talk with an advisor to put together that plan. If you really feel like you're behind the 8 ball, you may want to have somebody sit with you to help accelerate. I'm sure you're a very smart woman, and it's just a matter of time and energy, but you may feel like you don't have much of either of those right at this point. And it might be helpful to pay an advisor to help accelerate that a little bit, get the lay of the land for your situation, teach you, educate you so you feel really good and confident, but then accelerate a plan for you so you can see, okay, I know what I need to do to get from here to there, and not feel like, but I haven't learned enough to do it. You can have that plan in place and be learning about it at the same time.
I really love that. I can understand that late to the party feeling. You feel like you missed out. You feel like you have some lost years, but I love the advice of just making sure you're getting back on track now, getting back on things, investing in yourself when you still can, while you still can. I really love that message. Thank you, Evelyn.
You bet.
I have a couple more questions, so I'll try to be a little selective because I know we want to make sure we end straight on time. I'm getting a couple questions very specifically on just I bonds in general.
Oh, yeah.
Could you speak a little bit about those?
You bet. You bet. Of course, I bonds. The I stands for inflation, and everybody's favorite word right now. I bonds. That's not like an iWatch or an iPhone. It has nothing to do with Apple. It has everything to do with inflation. So I bonds are a type of government, U.S. government issued bond that both the principal, the amount that you pay for the bond, and the interest rate associated with the bond gets an inflation adjustment over a period of time. The government will actually every 6 months issue a new inflation adjustment that is applied to both the principal and the interest that your bond pays. And you can see how that could be really attractive, because if inflation is really on fire, maybe like now, it's nice to know that your bond is going to keep up with inflation. And so you can buy an I bond directly from the Treasury. Like I mentioned, you can buy treasuries directly from the U.S. government, treasurydirect.gov. If not .gov, check.com. I'm forgetting. And they got a little search bar, and you just search for I bond, and it'll give you instructions on how to do that. Now, there's a couple of things to remember about I bonds. The first is they limit how much you can buy. You can only, I say only, but you can buy up to $10,000 of I bonds online directly through the Treasury, and in this really quirky added channel to buy them. You can actually buy paper I bonds using a tax refund. I know, how random is that? It's just really kind of strange, but you can buy up to $10,000 through an online account that you would establish with the Treasury. And if you wanted to use a tax refund toward paper I bonds, you could buy an additional $5,000 worth. And so there's definitely, in the interest of time, I'd say make sure you read the fine print, because there's some restrictions on how long you have to keep them to get the inflation adjustment and things like that. But in this current inflationary environment, we're recommending that our clients, if they've got an extra $10,000 rattling around in their glove compartment, that they go purchase some I bonds.
Absolutely, that makes sense. And I have the perfect question to end our night with. You seem to do so well presenting. People are feeling so confident and trusting of you at the moment. People are curious whether you're taking on new clients, if there's any minimums to be aware of, or where to look for this information.
Oh, well, thank you very much. I appreciate that. Yes, we certainly take on new clients. We're true believers that everybody can benefit from planning, and there are a lot of great financial planners out there. And so, if folks, like I said, you certainly let's make a plan.org or planner search are good solutions. And if you really want to check out our website, it's Inspired Financial, and the suffix is .biz, B-I-Z. Thanks, Casey. That was very nice. Yeah. And I'm happy to chat. And I always tell folks, if for any reason we're not a good fit, we know a lot of really good financial planners, and we'll make sure that we connect you with the right one.
Lovely.
Wow. That's a wonderful offer, right, Elizabeth?
Absolutely.
Yes, yes. And there was one question from Casey that I forgot to ask you, Evelyn, and that was about the books and whether you had any recommendations on books, and we can put them up on our website or follow up.
I was going to say, let me offer that as a follow up. That we'll get you a handful of books. I really like The Investment Answer. It's short and sweet. It's less than 100 pages. I actually give it to all of our clients because I think it does a really nice job of summarizing how we approach investing. But let me think of a few. I'll get a few more, and we'll share it on the WISE website. The WISE website has some great resources. Make sure you check it out. And Angela's going to tell you this, but I'm going to get in my plug too.
On a podcast, all kinds of stuff.
Yeah. So Angela's going to mention this, but I want to get in my plug.
Right.
You're going to get a survey.
Elizabeth,
the survey.
Yeah. Yes. You stay on. Elizabeth, anything else? We want to thank all of our participants for joining us, staying with us for the whole time. And Elizabeth, great job fielding the questions. And again, SheVest has all kinds of resources as well. So there's a lot of help out there. You don't not have to go this alone, that's for sure. So and let me thank the SheVest team. We have Hannah, we have a whole WISE team, Darlene March and Casey Bahari. We have a whole team putting this on. So we thank you for joining us and hope you'll come to our next event.
Absolutely. And just as a friendly reminder, like Evelyn previewed it and Angela's already mentioned, we are going to have a survey pop up once we end the meeting. So please, please, please leave your feedback there so we can hear from you, get your feedback, and learn how we can better serve you together. Have a great night.
Well, thanks. Thank you, everyone, for joining us. Really appreciate it. Bye-bye.
Thank you.
Next time.
Good evening.